Hello everyone, it's this time of the month. Time to go over the previous month real estate market data for the Bay Area. Okay, let's dive in. Okay, so this is the data for the sold data for August of 2023. Across the board, we see some fluctuation here. One thing that jumps out is the Napa. It's a month over month. Its change is close to 14%. That doesn't make sense. I want you guys all to remember that Napa is a very volatile market. Okay, this is not real. The market is not going up 14% a month. Okay, because of the amount of transactions they have small. This data tend to fluctuate quite a bit. Okay, but overall, I think the market come to a plateau. Over the summer, we have seen price increase. Market is recovering, and we are getting to a point where the market is starting to lose steam. It's at the end of the summer, fall is coming, and the stock market is not doing so well. But however, we did see quite a bit of increase over summer and recover a lot of the loss from the height back in 2022. Summer 2022. So Alameda County, month over month, pretty much stay flat. The price went up 2.5% compared to last year at the same month. Contra Costa County dropped a little bit. Marin County still has not recovered from last year. Napa also lagging behind, not as bad as Marin. San Francisco, not too bad, given what's going on in the city, given everybody's moving out. Well, I shouldn't say everybody. A lot of people are moving out. The demand for real estate in the city just weakened substantially. Now, San Mateo stay flat. Which is really good. That means, yeah, it's holding strong. It's staying pretty close to the peak of the market back in 2022. Santa Clara even better. So this number is. I'm a little skeptical about this number. I'm not saying it's not real. It's just maybe that 1 month of 2022, Santa Clara County wasn't doing so well for whatever reason. So that's what caused this big gap between August this year and August last year. This 12%. So keep that in mind. Take it with a grain of salt. It's not really 12% above the peak of 2022. Okay, Solano County still a little bit below last year's height. So Sonoma, a tiny bit of gain. So all across the board, we see in 2022 market peaked and then came back down. In springtime, pick up a little bit, and it's recovering. I think overall, I would say we are about 8% below the height in 2022. Okay, so and also this time of the year, I want to look at the affordability data. So affordability data is something the California Association of Realtors compile once every quarter. Right now, I know we're at the end of September, but we still don't have the third quarter yet. We're looking at the Q2 data. Okay, let me show you. So yep, this is the Q2 data, Q2 2023. I tend to look at these numbers like periodically, about once a quarter, or maybe once every two quarters. And what the number means is this is the percentage of people that can afford to buy a home during that period of time. Okay, what this 16 means is in Alameda County, about 16% of the population can afford to buy a home. So this affordability, while we use the keyword as afford, right? It has two components, take into account two things. First one, the price of the home. Second, the payment, the mortgage payment. Okay, and also the third component is the amount of down payment it requires. So this assumes this 16% of people is estimated to be the amount of people that have the 20% down. Their income can afford a mortgage at this period of time. based on the interest rate in this period of time and based on the home price in this period of time. So this is 16% is actually a very low number. A lot of markets across the country will have like 20, 30, 40% of the population can afford to buy homes. 16 is very low. And I remember when the financial, the great, during the Great Recession, or before the Great Recession hit, at the height of the market back in 2007, it was just as low, like 16%, 15%. Some counties will have 17%. So homes are just as unaffordable as back in 2007. If you look at these two counties, you can see some counties a little bit better. Contra Costa County, 23%. But again, we would need to compare this with back in 2007 to really get a sense of how are we at the brink of an affordability crisis. So for Alameda County, which I'm very familiar with, it is. So 60%, it is at the brink. It was right around, the number was like that back in 2007 when the market was about to collapse. So, well, I'm not saying that the market will collapse this time. I'm just saying that, yes, it's very expensive and people cannot afford. A lot of people cannot afford. In today's environment, it's largely due to the increase in interest rate. It's crazy. So speaking of interest rate, let's take a look at this chart. This is a mortgage application compiled by the Mortgage Banker Association. And over here, you see that the orange line is the 30-year fixed average 30-year fixed mortgage rate, 7.38%. And this is this shaded graph here is the composite index of that they are tracking, is the index for mortgage application. As interest rate rose, application went down. The number of people who are interested in buying homes or want to bother getting mortgage go down. That's quite natural. So I think historically you can see that the average was around 5% in interest rate. So I think that's what buyers feel that's a comfortable point what people have. Of course, when we get down to 2-3%, like here, interest rate great, right? That's why you're having a huge demand in mortgage. But I think if we can get it back down to about 5%, people will be very happy, right? And people will be buying a lot more actively in buying homes. In today's market, we are at 7.31%. Well, another thing I wanted to mention is that overall, the market, there's a consensus in the market that the Fed is getting to the end of the rate hikes. They may still raise their interest rate maybe one more time in 2024, and then that's pretty much that's the general expectation is they will stop the rate hike and maybe start reducing interest rate in the next year. So that's the federal funds rate. Mortgage rate tend to follow that, not 100% precisely, but that's the market expectation. So what impact does this have, right? When the market has an expectation, people know, okay, the rate is gonna stop going up. Therefore, I can hold out. Meaning, if I just wait a little bit, I like getting to the end of the tunnel. If I just wait a little bit longer, interest rate will go down. So that actually stops a lot of people from buying right now. Okay, so people just think that, okay, I should just hold on, wait a few more months, interest will go down, and things will be more affordable. So that puts pressure on the demand today, because people who don't have to buy a home right now, a lot of them will rather wait because they know if they're at the end of the tunnel, they will see the light very soon. So that is going to put pressure on basically the remainder of 2023. So and not just because we are getting out of summer, we are in the sort of into the fall already. And I don't think this fall we will have a robust market like a normal fall season. Right now, this for the fall and winter of 2023, the market will stay pretty flat, if or probably go down a little bit compared to summer, and so yeah, that's basically in the near term of this where I think the market is heading to. And let's see. So there's one more thing I would like to share with you guys. So there's this California housing market update slide. 57 slides. I'm not going to go through all of it, because a lot of them has to do with Southern California, Central California. There's one slide that I found very interesting. I want to show you. Okay, so this is the Bay Area snapshot. Year over year, the sales went down 18%, just because interest rates high. People don't really want to buy home. People cannot afford home. People who want to move, they realize that if I sell my home, I'll give up my current mortgage, which may be 3% at interest rate, and in exchange, if I buy a home, I'm getting 7.3% interest rate today. It just doesn't make sense. People just do not want to sell. People don't want to buy. That's the reality we face right now. So that said, the inventory is still very low because people don't want to sell. People, after they sell, they don't know, they have a lot more expensive mortgage. So that's why people don't want to sell. All right, let's look at some interesting numbers. The one I would like you guys to look at is this. Okay, sales decline was the smallest at the top price segment. So this at this top price, basically close to 2 mil, actually 2 mil segment has the least amount of decline in sales. Okay, things in the lower price range, those are people with lower income. They cannot increase in interest rate has a proportionally bigger impact to them, to people with lower income than the people with really high income people. So that we kind of expected that, but the graph just confirmed that now that the high end market is still going pretty strong when the interest rate goes up. And another reason for this phenomenon is that more people in this price point are getting the higher percentage buyer in this price point, they are actually paying all cash. Yeah, people buying $4 or $5 million home with all cash. If you don't have $20 million sitting around, you don't buy $4 or $5 million home all cash. So yeah, there are plenty of people like that out there. That's the world we live in. Okay, so there's another one, another slide I want to share. So price per square foot gap between home types narrows slightly. So this is data across California. Okay, they're saying this is the price per square foot for single family home versus condo. Actually, it's narrowing down a little bit. So I think they mislabeled this. Condo is higher than single family home. I think they mislabeled the two. It's not like that historically, but well, it should be the other way around. Condo is here. Single family home is up there. So, but I guess overall, that's my point is that in the Bay Area, this is not the case. Okay, the condo is still depressed. And single family home still carries a big premium. The gap is actually widening and not narrowed. So yeah, it sucks for condo home owners. It's good for condo buyers, but at the same time, we need to keep in mind that as when it comes time for them to sell, the condo also don't sell as well as single family homes. So, and when we're looking at $400-500 per square foot of price, and also think about how much it's going to cost to build nowadays. I talked to a builder recently. He was telling me, yeah, it generally costs about $420 per square foot to build. So the cost of building is just very close to the cost of buying homes nowadays. So it's that's why not a lot of building activity is going on. And for those of you who want to expand a home, adding new square footage, I think you want to think twice. Unless you bought a home a long time ago, if you just buy a home in today's market, you will basically be spending just as much money adding more square footage to it than to just buy a bigger home and save yourself a lot of trouble and unknowns. So just keep that in mind. But if you bought your home long time ago, you don't want to move, you want to just expand it, yeah, go for it. It makes sense because today's market, in the Bay Area, oftentimes we see per square foot homes in the range of like $800 to $1,000, even $1,100. Spending $400,000. Sorry, I mean 800 per square foot to 1100 per square foot. So spending the $400 or $500 per square foot to add on to it will still make a lot of sense. Not so much for the rest of California. So I think this is about it for today's episode. Thank you for joining me. I will see you next time.